Welcome to Windfall Edutech Beginners Module. Chapter 2. Types of equity market. Types of capital, share market. Primary market. Types of issues in primary market. Issue, IPO. Issue, IPO, fixed price method. Issue, IPO, bookbuilding method. Issue, IPO, green shoe option. Issue, IPO, SEBI's role. Issue, IPO, FPO. Issue, IPO, rights. Issue, IPO, preferential. Secondary market, dual function. Secondary market, role of stock exchange. Primary or secondary market, which one for us? Primary or secondary market, comparison. Types of capital, share market. There are two sub-markets under this to choose from. Primary market, new shares are traded for the first time. Shares issued by the company directly to investors. Issuers of new shares are generally companies, institutions, and government. It is the market for new long-term equity capital. Primary market and secondary market. A market where the you and me can buy and sell shares, after the company has finished its IPO and is listed in the market. You can sell the shares to your friend in this market. Of course you will sell at a higher price to make some profits. So here you decided the price to sell and that becomes the current price of that share. Most of the trading happens in this market. Let's get into details of each market now. Primary market. This is a market to raise funds for prospective business. Could be one of your dream business for all you know. Most of the startup companies are formed privately by promoters with their own contribution or bank loans. However, many times promoters' capital and bank borrowings are not sufficient to carry on or expand the business. So what do? They invite you and me to buy shares. Types of issues at primary market. Through issues or simple words shares in four categories. IPO, initial public offer. Follow-on public offer. Rights issue. Preferential issue. Issue, IPO, initial public offer. When an unlisted company makes a fresh issue of shares for the first time to public, it is called as an IPO. Simple to understand, isn't it? Okay, so how do they issue these shares in the market? Through normal public issue, fixed price method. Book building method. Issue, IPO, fixed price method. Company decides a fixed price of their share. This price is made public. You and me know that a company X has its IPO being issued at rupees Y. Issue, IPO, bookbuilding method. Company decides a range of price called price band of their share to reach to an effective price discovery. It is a mechanism where the book for the offer is open. The bids are collected from you and me at various prices during that period. Prices need to be within the price band specified by the issuer under the book-building process. On the basis of demand generated for the price, issue price is determined after the bid closure. Let's see the process of book-building. Issue, IPO, book-building process. Public offer through book-building process has a book-running lead manager, a merchant banker who manages the issue. An order book is prepared where you and me state the quantity of the share that they are willing to buy at a price within the price band. An issue through a book-building process remains open for 3 to 7 days subject to extension of 3 days in case if the issuer decides to revise the floor price and the price band. Once the issue period is over, and a book has been built, book-running lead manager along with the issuing company in conjunction with one another decides on the cut-off price. What is the end result? Let's see. Issue, IPO, bookbuilding, end result. Wow, we just got our effective price discovered by the market. If you who have bid below the price discovered, you are not allotted any shares. If you bid at a price higher than the price discovered, you have higher chances of share allotment. Once the issue period is over, and a book has been built, book-running lead manager along with the issuing company in conjunction with one another decides on the price discovered. But, what happens if the shares are oversubscribed? Issue, IPO, book-building oversubscription, green shoe option. In case of oversubscription, company can exercise a green shoe option to stabilize the price discovered. Oversubscription of issue is an indication that large number of you and me interested in buying the IPO. If demand exceeds supply, prices might rise to phenomenon levels after listing of the stock. Greenshoe option is a clause in the underwriting agreement of an IPO, which allows to sell additional shares, usually 15%, to the you and me if the demand exceeds expectations and the stock trades above its offering price. In short, the over-allotment provision to give stability of an IPO. Issue, IPO, SEBI's role. Any company, institution before coming up with an IPO of more than 50 lots, need to file a draft offer document with the market regulator SEBI. Company can proceed with the issue only after getting approval or observation letter from SEBI. Observation letter given by SEBI is valid for 3 months. If a company fails to open the issue in 3 months, it has to get a second approval from SEBI. Issue, FPO, follow on public offer. Follow on public offer is made by the companies which are already listed in the secondary market. Listed companies that are unable to acquire loan or do not want to take loan, opt for FPO route. Listed companies will use the money raised from FPO offer for their expansion or modernization plans. FPO offer price band is fixed and is derived from the existing market price of the company. Issue, rights. In rights issue, company sells new shares in order to raise money. Under rights issue, company issues shares to already existing shareholders in proportion to their current shareholding. Price at which shares are offered in rights issue is usually at discount to current market price. A tradable share which allows the existing shareholders who do not wish to purchase new shares to sell their rights to an interested party. If the rights are not taken up, the issuing company can sell these rights on the right holder's behalf. Issue, preferential, an issue of shares by listed companies to selected group of individuals. A faster way for the companies to raise equity capital. Of course, the issuing company has to comply with the Companies Act and SEBI guidelines. Secondary market. This is a market to trade for existing business. Once the shares that are initially offered to public get listed, they are free to be traded in secondary market. Majority of trading is done in secondary market. Equity market and debt market are all part of secondary market. Secondary market, dual function. Role is twofold, i.e. helping you and me as well as the company. From our point of view, secondary market provides a ready-made platform to trade the shares they hold. From a company's point of view, secondary market helps in its monitoring and control purpose. It helps the companies in enabling implementation of incentive-based management contracts, collating information, and facilitating value-enhancing control activities that aids in management decision. Secondary market, role of stock exchange. It provides common trading platform to you and me. You and me need not meet in person, but trade on electronic trading platform provided by stock exchange. It protects the interest of you and me by upholding rules and regulations for fair transactions between us. It regulates the trading activities of its member brokers according to those rules. Primary and secondary market. Which one for us? Both the primary and secondary market is for us, but with a little twist. Don't worry, I have made it very simple to understand. I will explain a comparison in both, and you will see the simplicity. Follow me. Primary and secondary market, comparison. Primary market, secondary market, only buy shares one way. Trading of shares two way. 3 categories of investors allocated percent of total shares issued. 3 participants with no limit on trading percent. Retail investors RII 35% allotment. Non-institutional investors NII at least 15% allotment. Qualified institutional buyer QIB up to 50% allotment. Buyers, sellers, intermediaries, brokers, banks, depositories. NII are high net worth individuals. QIB are mutual funds, financial institutions, insurance companies, provident funds. Buyers and sellers are high net worth individuals HNI, mutual fund houses, corporate and institutional investors FII, foreign institutional investors. Brokers are registered members of stock exchange acting as a middleman between stock exchange and investors. Investor needs to enroll with these brokers for a fee for transacting in stock exchange. Thank you. Revise and get ready for the next